So now let's see how that last component can fit into our example in some potential ways. So the first thing, of course, that occurs with quarter amortization is that you have to have a beginning balance. If you don't have a beginning balance, so if you have zero balance, then you don't have quarter amortization. So we can apply that to our example, where first we didn't have a balance in our quarter. I'm sorry, we didn't have a balance in our unrecognized gains or losses. And then we had a loss of 91,360, which created a balance in the second year, at the end of the second year. Now that means that going forward, we would have to be cognizant of whether or not we had enough of a balance to warrant quarter amortizations. Because remember, as long as this is not too big, we don't have to worry about it. So in order to understand whether that's too big, we look for the corridor. It's 10% of the projected benefit obligation or the plan asset at the beginning of the year. So we're looking then, if we finished up that last problem, we're looking at the balance at the beginning of the next year, and then we would look to see whether it was too big by looking at 10% of the projected benefit obligation or plan assets. 10% is just an arbitrary number that never changes. It's sort of if it's big relative to the amounts of obligation and assets we're talking about, then we have an issue. If not, then we don't. If it is larger than the corridor, if the beginning balance of 91,360 happened to be bigger than 10% of the PBO or plan assets, then we would have a corridor. We would have to apply quarter amortization, and we'd want to look for the difference between our unrecognized gains or losses in the corridor. In order to calculate that amount, we just want to divide up the difference between the corridor minus the beginning balance over the service life of employees. And again, that's sort of keeping with the matching principle, where we are looking at extending a cost across the years that we're going to get use out of it. Our pensions are tied to our employees, and more specifically to the amount of time they're going to be employed at our firm. It's just the cost of employing them, and we want to stretch that corridor over that amount of time in order to appropriately match it to how we're incurring the expense. It's also not a straight line process. So just because we're amortizing $100 million this year doesn't mean that that's going to be constant. You have to reevaluate it at the beginning of each year, and it's going to be different because the quarter minus the beginning balance is going to be different every year. So looking at a simplified example, we have a beginning balance of unrecognized loss at the beginning of the year. So that's going to be an AOCI debit balance. And then we have a projected benefit obligation of $3,600, plan assets of $3,800, and the average remaining service life of our employees is 13 years. So the first thing we would do is calculate the quarter. The quarter is, just remember, 10% times the bigger of 3,600 or 3,800. Because 3,800 is bigger, we take that number, and we have a corridor of $380. Because our beginning balance of 900 is larger than the corridor, that means that it's too large. We have to apply amortization. Well, how much are we going to amortize? That's in the next question, where we take the difference between those two, 900 minus, this is just asking if it's bigger. So yes, $380 is less than 900, which implies that we amortize. And now the amount we amortize is going to be $900 minus $380, which is $520. This is the amount to amortize over the remaining service life of our employees, which is 13 years. So that comes out to $40. So let's look at how this is going to affect our account then. If we have the AOCI gains loss account and we had $900 in here, we decided that $900 balance is too big. Remember, it was a loss balance. And so we're going to amortize $40 of the loss balance. So we're amortizing a loss balance, which is giving me if I applied that corridor and had no other AOCI items during the year, it would end up giving me an $860 balance. And so it is a reduced balance, right? The other aspect of this is, how does that affect pension expense? Well, since we're taking a lost balance and amortizing it, we're slowly recognizing a loss in pension expense. And so that $40 is going to increase pension expense because it is a previously unrecognized loss. So if we're recognizing a loss in this year's pension expense, is going to drive it up by the amount we're amortizing. And that's how quarter amortization works. Let's look at another example to kind of explore this quarter amortization along with the beginning balance in our AOCI account. So in this problem, you have various amounts at the beginning of every year. So these are beginning of the year amounts, which is worth noting because it's always, again, a test you want to invoke at the beginning of the year. You have information about the plan assets in the PBO. We also have information about the service life of our employees in 2014 and 2015. It was 10-year service life remaining. And then in 2016 and 2017, it's 12 years. So we must have hired some new blood, or people decided to stay longer. There was no gain or loss outstanding at the beginning of 2014. So that means that my AOCI account was at a zero balance. Now, I did have a net gain or loss that occurred over the period. So remember, these are balance sheet gains or losses that will affect over a period of time. So from 2014 to 2015, I had a $280,000 loss. When we look at that on the AOCI, right, we had no beginning balance, 1/1/14, which is when these, remember, beginning of the year amounts are recorded. We had nothing. So we had a beginning OCI at 1/1/14, or 1/1 every year, in this case 2014, of 0. The corridor can still be calculated because we did have a PBO that was $2,200,000 versus plan assets of $1,900,000. This would be the one we want to take because it's bigger than the plan assets. And when we take 10% of that, we get $220,000. That's the corridor. The corridor is obviously greater, and so we don't have to invoke any quarter amortization at the beginning of that year. We do have a change in our AOCI gains loss over the year. We had a $280,000 loss, which is going to increase the debit balance of that account. This is now 1/1/15. So we do have a beginning balance in 1/1/15. We need to express that here, 280,000. That's our beginning balance. Then we look for the bigger of the two, 2,600,000. Apply the 10% to determine our corridor. That's $260,000 of a corridor. We have our beginning balance being greater than that amount. Because it's greater, that means it's too big. So we're going to have to apply quarter amortization. The quarter amortization is going to be the difference between those two, 280 minus 260, which is equal to 20,000. And then we're going to divide that over the service life. This is happening in 2015, 10 years. So my quarter amortization is $2,000 for that year. Now when I'm going to the balance of my AOCI for that year, remember, I had a 280 beginning balance. I reduced it by amortizing some of it. The 2,000 would be a credit since I'm amortizing a debit balance. But I also had a loss in that year. So that's going to also increase my debit balance. So now I have a $368,000 debit balance in my AOCI account. That's at the beginning of 2016. Now looking again, which of these is going to be my corridor? The greater of the two times 10% would give me a quarter of 290,000. And again, my beginning OCI balance is bigger. Doesn't matter if it's a debit balance, a credit balance, doesn't matter if I'm talking about the PBO or the plain assets. It's an extremely simplified process. Don't make it too complicated. I do have a quarter amortization amount. It's going to be the difference between my outstanding balance and the corridor, which in this case turns out to be 78,000. This is the beginning balance. This is my corridor, 78,000 divided over now 12 years of a service life because we're in 2016, and that gives me $6,500 of quarter amortization to apply in 2016. So because I'm amortizing a debit balance, I want to credit it. And I also had a loss of $12,000 in 2016. So that would increase my beginning balance of my AOC, of my debit balance of my AOCI even more. 368 plus 12,000 minus 6,500 gives me a balance of 373,500. So now it's a pretty big balance still to begin the year with in 2017. However, when I go to calculate my corridor from the beginning of the year 2017 numbers, I have my PBO at 3,900,000 times 10%. Well, now that's 390,000, which is greater than the beginning balance, which means I had zero corridor for this year. And remember, I had 6,500 for the prior year. Right. So again, gives you a little bit of practice with determining the corridor amounts. It also gives you some practice with determining the beginning balance of your AOCI, what goes into the AOCI, and how this works. You know, and I can't emphasize enough that you're always checking the corridor as of January 1st of each year. A lot of people mess that up. The next thing that they'll mess up is typically they'll try amortizing the corridor. So for example, instead of amortizing the difference between these two of 20,000, they'll try to amortize 260,000 instead. So be careful with that. And you're always wanting to amortize the difference between the two. I'm going to go over a couple of the worksheet examples because the worksheet presents a different format to record this information. And some people actually prefer it rather than the T account analysis. So I give you the same information, where we begin with plan assets, where we begin with the PBO. Now you have to start recording it. These are the beginning balances, and so this is the beginning balance line. Notice that I have T accounts here. This is essentially the AOCI PSC account. This is my AOCI gains and loss account. This is my pension asset liability account. So they all have beginning balances. I really don't worry about the beginning cash balance. Every company has a huge beginning cash balance, and their contributions aren't going to exceed that balance. So we're not going to worry too much about it. Remember, pension expense is a nominal account, so it will always have a zero balance as a nominal account. And we're not going to see the difference there. So we're looking at a change in balances across these accounts, and also our memo for our footnotes will have the projected benefit obligation and the plain assets as well. We can go ahead and insert their beginning balances. Now, because the PDO is sort of a liability account, I'm going to go ahead and do a notation where if the balance is credit, then it's going to be in parentheses, right? So any credit balances are going to be parentheses. Now, looking at the rest of this, how do we fill it out? Well, we have pension expense, and essentially this is going to turn into an equation line for you to add up the components of pension expense. Service costs, interest costs. Notice they have an actual return and an unexpected return, but if we combine the information between these two accounts, sum them up, we can form the expected return just by algebraic manipulation. We have amortization of prior service cost, quarter amortization, all the usual suspects. So my service cost is given to me up above 9,000. I can go ahead and insert that. Now, service cost is a debit account because we're increasing pension expense. The same thing will go with interest cost. Remember, interest cost is going to be the discount rate applied to the beginning balance of the PBO. And so that gives me $10,000. That also increases in expense, which is a debit effect. So I'm not going to put that in parentheses. The expected return is 10% of plain assets. So we're going to go ahead and figure that out as well. 10% of plain assets gives me a $10,000 expected return. Now, the actual return was 10,000. And so the actual return, which is what we're going to record here, and the expected return aren't different. So I can go ahead and put in a 0 for the unexpected return, because when I sum them, remember, it gives me the expected return, which is 10,000. Now, the difference between this and the prior two items is that because my return decreases pension expense, I want to have a credit because it is reducing an expense. I don't have any amortization of prior service costs. I don't have any corridor because I don't have a balance in my AOCI gains or loss account. I can now total those accounts individually to get what my pension expense is. So 9,000 plus 10 minus 10 is going to give me a $9,000 balance. And again, that would be a debit balance because I have more debits, $19,000, than credits of 10,000. Now the cash, this just refers to the cash contributions because this is the only way that cash is actually exiting our firm, is when we put it into the plan assets. So that $8,000 of cash is again going to be credited and put there. The benefits paid. Now remember, the benefits paid in a defined benefit program are paid out of the plan assets. So when I paid $7,000 in benefits, I'm going to end up paying that out of my plan assets. And that also reduces my PBO. It's reducing my obligation. It's a debit transaction. So again, 7,000 here on the PBO column, not parentheses. Plan assets, it is reducing plan assets. It is a parenthesis item. Okay. I don't have any prior service cost. Since I have no prior service cost, there's no change in this account. The ending balance is 0. Going from 0 to 0, I have to adjust it by $0. The cash, because there's no other effects, comes down as a credit of 8,000. Because the actual return and the expected return were the same, I had no unexpected return, so I had no effect here. I had no amortization, so I had no effect in the amortization of the PSC column. I had no corridor, so again, I had no unrecognized gain or loss go here. What else do we have to carry over? Well, notice 7,000 is balancing out against 7,000, right? I'm going to have balancing effects throughout. Service cost of 9,000 is going to be balanced out by the effect of it increasing the PBO. Since it's increasing an obligation, I'm crediting it. Same thing with interest cost. Notice again, 9,000 balances out against 9,000, leaving 0 for the row. Actual return, where is that going to balance out? It's going to balance out against plan assets. And again, it's going to be a debit because it increases that account. The contributions to the assets, well, it leaves the firm, but where does that go to? It goes to the plan assets, and so that increases my plan assets by $8,000. Now that you have these reconciled fully, which is just like filling out the T accounts, you can add them up. You'll get $112,000 for the projected benefit obligation and $111,000 for your plan assets. This is a credit balance because it's an obligation. You look at the difference between these two and you decide, all right, I have an underfunded plan. I have it underfunded by 1,000, which means that then I need a liability balance here of 1,000. If I started off at a $0 balance and I need a liability balance, then my entry has to put a credit of $1,000 on my pension asset liability. And again, there was no shift in my AOCI from beginning to end. Therefore, there is no entry required for that. Notice that this entry then forms our pension expense reconciliation, where we would debit pension expense by $9,000, which is hinted at here. We would credit our cash by $8,000, which is established here. And then we would credit pension asset liability by 1,000, as established here. And then this also completes that year's pension recognition. Right. So let's throw something a little bit more complicated in there. And we'll look at 2017. Now, 2017 is just rolling forward. It has the correct balances, 111 and 112. We can go ahead and insert them here. We have a PBO beginning of 112. And again, that's an obligation, so we'll go ahead and put that in parentheses. The plan assets is 111, beginning balance. Now, everything else, remember we had a beginning balance of 0 in our prior service cost, 0 in our unrecognized gains or losses, and we had a credit balance of 1,000 in our pension asset liability. Right? Those are the balances we're trying to keep track of and roll forward. Let's look at the rest of this information. Now, we had a new prior service cost of $80,000. That's a new row here. Now, the new prior service cost itself doesn't affect pension expense. The amortization of it does. But when we do this prior service cost, it's going to increase our prior service costs account. And it also increases my PBO. So how would this be journalized? Well, you can really do two things. You can either do a two-step journalization process or just take care of it in one step. I recommend one step, right? As long as you recognize that you are debiting prior service costs here, and because you're having to pay out additional benefits, this is increasing your projected benefit obligation, you'll be okay. There's a little bit more of a refined explanation, but you don't need it right now. This does set the amount of my revised beginning PBO. 112 plus 80 gives me 192. And remember, I'm going to want to use that to determine interest costs. So go ahead and do that just to remind yourself that that's the amount that I'm going to apply that rate to. So it actually comes out to $19,200, which starts me down my pension expense. $9,500 service cost, $19,200 interest cost. A lot of people like the worksheet just because it's very, it flows very well for them. Then they can just carry these numbers over, remembering that service cost impacts the PBO, interest cost impacts the PBO, 9,500 in parenthesis, 19,200 in parentheses. The actual return and the unexpected return. So let's figure out what we expected first. We expected it to be 10% of my plan assets, which gives me 11,100. That's what I expected. What did I actually get? I got 11,100. So again, I don't have to adjust that actual return. 11,100 will credit the pension expense and increase my plan assets. Because the expected return is 11,100, we don't have to adjust it with an unexpected return. So that means that we have no adjustment to my AOCI gains and loss account. We do have amortization of the prior service cost, which I gave you here, 27,200. Now that's going to reduce my prior service cost, 27,200, And since we're reducing it, we need to credit this a balance now. Now, recognizing this amount in piece is going to increase my pension expense for the period by the amount that I amortized it. Right? But since these offset, there's no change to the PBO or plan assets. I have no quarter amortization because I started with a zero balance in my gains or loss account. My contributions were $20,000, so $20,000 left my company and ended up in the pension asset. I'm sorry, in the plan asset account. And I paid benefits of $8,000, which means I reduced my PBO by $8,000 and also reduced the amount of assets I have since I paid it out of my assets account. Now I just have to go through and add together these items for pension expense, calculating pension expense of $44,800. The cash rolls down $20,000. That's going to be a credit adjustment. Now, because I actually have a balance going on here, I can look at zero. I inputted $80,000, took out $27,200. Then that would leave me with 80 minus 27.2, 52,800. Now let's look real quickly what that, just at a T account, just to remind yourself what that would look like. We're storing the PSC as a debit balance here because as we amortize pieces of it, it credits that account. And so in essence, the way I think about it is I'm crediting the AOC PSC, and if I'm going to debit something else, I'm adding to pension expense by $27,200. This is a debit balance account. We credited it, which means that overall we had a $52,800 debit adjustment to this account to establish this balance. It's looking at the fact that I started at a zero balance, ended at a $52,800 balance, so the change is $52,800. That's what I meant by looking at the full picture rather than recording $80,000 and then recording a credit of $27,200. We had no amortization, so still the AOCI gains and loss account is at a $0 balance, so there's no change there. We sum up our PBO, which should come to $212,700. Our plan assets would come to $134,100. So we look at the difference between these two, and since $212,700 less $134,100, that indicates that it's underfunded by $78,600. If it's underfunded, that means that we need to record a liability of that amount. The difference between those two is the amount that needs to be recorded, $77,600. And again, this parallels the approach that we would use with T accounts. It started at a $1,000 credit balance. It needs to end up at a $78,000 credit balance. Then we should adjust it by $77,600. Okay. And again, now we're also setting this up as our journal entry, where if we're just looking at the entire thing, we have pension expense of $44,800. We have cash contributed of $20,000. We have an overall debit effect to my AOCI PSC account of $52,800. And then we have the final adjustment, which is our pension asset liability, $77,600. All right. I'm going to go ahead and do one more year. If we look at 2018, if you want, you can pause the video. I would recommend, if you're feeling good about it, pause it, do this on your own, check it with what I do. I will give you the opportunity opportunity to do 2019 and record that as a part of the final pension video. Anyway, plan assets at the beginning of the year, 134, 100. PBO at the beginning of the year, 212, 700. These just carried forward from the prior balances at the end of the year. What else carries forward? Of course, all our real accounts. So our prior service cost account should be at a $52,800 debit balance. We still don't have anything in our AOCI gains or loss, and our pension asset liability is at a $78,600 credit balance because it was underfunded. Remember, it's underfunded because the difference between these two leans toward the PBO. As usual. Now, one thing that students sometimes get confused about is that when we initiate a prior service cost, that's when it increases the PBO, but once it's in there, we don't have to shift the PBO anymore. So there is no new prior service cost this time. We can take the beginning PBO at 212,700 to determine interest cost. So that's $21,270 of interest cost. We have a service cost of $13,000. We can record those under pension expense and then offset them as increases to the PBO. All right, now we have the actual return of $12,000. Let's see if it matches the expected return. The expected return is 10% of plan assets. We apply that to the beginning balance. 13,410 is the expected return. This is different, right? Now this is the one case now where we've seen a difference so far. 13,410 is what I expected. 12,000 is what I actually got. So that means that I had an unexpected loss of $1,410. So we expected a return of 13,410. We got an actual return of 12,000. Well, remember, we want this column to add up to the expected return. In that case, then, I have to add this unexpected loss in order to get the $13,000 expected return. Together, those give me the $13,410 expected return that should have decreased pension expense. Now, carry these guys over. Remember, the actual return is going to increase plan assets by $12,000. The unexpected portion of this return is going to be a loss in my AOCI gains or loss, right? Remember, it's a loss. It's a debit balance. Therefore, it's a positive number in our worksheet. The amortization of our prior service cost is $20,800, which is going to add to pension expense. We don't have any quarter amortization because it's a beginning of the year item, and we have a $0 balance there. Obviously, we might have some now because we all of a sudden have a balance, right? For contributions, we contributed $24,000 to the plan. That is a credit to the company's cash balance, but it funds into plan assets and adds to that overall balance. The benefits paid were $10,500. That's going to decrease my obligation and debit my PBO. It will reduce the amount of plan assets I have because that's where they are paid out of. I have amortization that I haven't carried over. $20,800 needs to be credited against my AOCI PSC account so that I can appropriately update that account. And the final item is, oops, I put these benefits on the wrong row. They should have gone up there because I have an actuarial loss this year, $28,530. Remember, an actuarial loss is going to go into my unrecognized loss. in its entirety, and it's also going to increase the PBO because it's a loss. If you need help remembering that, think of a loss going to a liability account. In this case, we're talking about the actuarial loss going into the PBO, debit, credit. Loss going into a liability is a pretty common transaction. So that's the relationship between the actuarial loss or gain and the PBO. So now totaling these PBOs up, we get a ending balance of 265 on the dot, and the plan assets at 159,600. What else can we total up here? Pension expense is going to total up to 41,660. The cash effect will come down to inform the journal entry. And again, now we had a $52,800 debit balance. We credited it by $20,800. And then so we're going to have a $32,000 balance in this account. And just to sort of guide you again, you can always draw a T account to think about it. 52,800 reduced by 20,800, and now we have just 32,000 remaining. That's what that balance is. But the overall effect is the difference between these two. So that was a credit of 20,800. Now our AOCI has changed drastically, right? From a $0 balance increased by this amount. So that actually gives me a balance of $29,940. It is a loss balance, and so it would be a debit balance in my AOCI account. It would have started at 0. I would have had 1,410. I would have added to that 28,530. The debit balance is represented by a positive number here. And the difference is all of that. So it changed by 29,940. Then finally, I'll look at the difference between these two accounts to determine if I'm overfunded or underfunded. Because the PBO is larger, I am underfunded. I am underfunded by $105,400. When you take the difference between those two, that's what you get. That becomes the new balance that I need here, $105,400. And so in order to get that credit balance, I need to adjust from a $78,600 balance, which is a $26,800 credit adjustment to the account. Because it's all laid out now, you can simply make the journal entry by looking at this. Pension expense is $41,660. I'll start it here, since I ran out of room below. I'm going to credit cash, leave some room, because you're going to have debits for $24,000. You're going to also credit your prior service cost because you amortized for $20,800. Your AOCI gains and loss account was created as a loss in this case of $29,940. And the final item is our pension asset liability, which was credited for $26,800. And again, of course, this should all add up. Debits will equal credits with another moving piece added. And now, of course, you have to be aware you have a beginning balance in your AOCI gains and loss account. And so you need to check for quarter amortization in 2019.